Welcome to the Ellsworth Advisors monthly update for July 2025. I'm Kelly Keenan. This is Cameron Mealy. Today we'll discuss the latest economic data, how our portfolios performed in July, how they're doing year to date, and then also what our outlook is for the next couple months. Cameron, why don't you kick us off with some economic numbers?
Will do. Good morning, everybody. Hope everybody's well out there. By reference, today is Tuesday, August 5th. And if my sister's watching this video, happy birthday, Erica. I hope you have a great day. Really, over the last month, Kelly, we've had kind of a tale of two economic stories. We've seen the good and we've seen maybe the bad. So let's jump in right away with interest rates. The Fed meeting from July 29th and 30th, you probably saw in the financial headlines, the Fed decided to hold their Fed funds target rate at 4.25 to 4.5. This has created a lot of angst with the Trump administration. Trump is very forceful that he'd like to see the Fed make a cut, but right now they say that the data wants them to remain pat. The next Fed meeting is September 16th and 17th, so a little bit of a break before the Fed meets again. We'll see how the economic numbers come out. I think there still is expectation that we're going to see rate cuts before the end of the year. Don't know when they're going to happen, don't know the magnitude. Best Wall Street consensus is still 50 basis points to 25 basis point cuts by the end of the year. So let's talk about the economy, the good. On July 30th, the Bureau of Economic Analysis reported that according to its advance estimate, GDP for the second quarter came in at an annualized increase of 3%. This bested the consensus Wall Street estimate of 2.3%, and this compares to a 0.5% decline in the first quarter of GDP. As we generally talk, a 2% GDP growth, the annualized growth rate is kind of a stated target. It's not really a hard number, but it's kind of a stated preferred target. So obviously 3% showing some strong growth. As we've talked about over several updates, likely a lot of that is inventory that was pre-bought prior to any tariffs now coming into the system. So it might be an artificially inflated number. We'll have to see.
You kind of have to smooth out the 2 quarters, negative, positive, pull forward of inventories.
Yeah,
-5.
You take 3 minus. We're
3
probably
minus
right
half okay. We're probably mid. Somewhere between 1.5% 2% GDP growth.
Yep, which is again
we're growing, but not very strong.
Yeah, pretty normalized. And then if we advance that forward, let's look at the Atlanta Fed's GDP Now forecast. As of August 1st, the Atlanta Fed's GDP Now forecast model is predicting third quarter GDP will increase at an annualized rate of 2.1%. So again, that comes back to a more normalized number. But again, even the Atlanta Fed stated that they're still concerned with their model because of the news on tariffs. There's a lot of movement, and so lower confidence on that number. So GDP appears to be strong based on the read. And then anybody who's paid attention to the financial headlines is going to know about the June jobs report. On August 1st, the Bureau of Labor Statistics announced that 73,000 new jobs were added in June, and that was a significant disappointment compared to the 117,500 that was the consensus estimate. So there was a lot of hand-wringing around, is this really a sign of a slowing economy? Do we look at the GDP number? Do we look at the employment situation? There were revisions to past employment numbers, which prompted President Trump to remove the chair of the Bureau of Labor Statistics because we have now seen significant material revisions to the job numbers.
Yeah, I think we need to talk about that a little bit. I don't know if removing that person, that's like killing the messenger versus the message. The reality is the way that the BLS comes up with their numbers is based on a survey. And so they do a survey, and then as you get further along, they actually get the hard data. And there's always been adjustments to those initial estimates. And what's happened is ever since COVID, prior to COVID, the response to the survey had been running around 90%. Since COVID, response to the surveys is more in that 50 to 60% range. So obviously the survey data, not as robust. And then when the real numbers come in, okay, they have to make, if you had 90% participation, smaller adjustments, 50, 60% participation, a lot larger adjustments. So the skew has gotten a lot larger, and I don't think it's necessarily politically motivated. It's the fact that things have changed, and the way they calculate and the methodology has not changed. And there's a lot of data out there. There's probably more efficient ways to do it.
Yeah.
Now, the reality is the private sector, the financial sector, most large, banks, research services, research businesses, ADP, they have
survey.
all their different ways of measuring it. So the key with all the data really isn't so much the hard numbers, but it's more about direction and magnitude. And I think with the firing of the chairman, that's probably okay. Yeah, things need to be shook up. I don't think it's a leadership needs to be shook up, but the reality is they need to relook at how they're coming
Their
up with these numbers.
They either need to delay a couple of weeks to get in more information, or if they have to change the methodology.
The methodology has to be adjusted, has to be updated.
And as you know, our government changing methodology is like turning the Titanic.
Right.
It's going to take it.
The reality there is, okay, now you change the methodology. How relevant are these numbers to past numbers? Once again, the actual numbers aren't, and the preciseness of the actual numbers aren't as important as to direction and magnitude. And the reality is we're looking at potentially 2% GDP growth for the year, which, that's all right. Mm-hmm. It's not great. It's not rip roaring. Obviously through much of the 2000 teens, we were in that 2% range, and things were pretty good. We're kind of there now. So as we've been saying, the economy's decent. It's not great. It's not horrible. We're still a ways away from negative growth, but 2%, that's not a huge margin. So we're not shrinking, we're not rip roaring growing. So we're in a decent environment. Interest rate wise, with the Fed funds we need to be in the threes by the end of the year.
Time for it to start coming down, in my opinion.
Inflation wise, the numbers have been pretty stable. And that, once again, it's kind of more about direction and stability versus actually the hard number. The Fed's targets 2. We've been stable around where we're at now. So the trend may be not so much trending towards 2, which the tariffs are adding something in there. Nobody knows what that magnitude is. Perhaps we'd be closer to 2 if we weren't going through this tariff stuff. But the reality is things are fairly stable. Maybe we're at a little higher elevated point between 2 and 3, but still with Fed funds, you could justify bringing them down.
Absolutely.
And if employment is weakening, that gives the Fed room to.
And we have some of the
need to
highest
be.
interest rates in the world now.
Correct.
So from a competitive standpoint, that does hurt. I mean, what I think you can take into this jobs situation, I was going to call it a debacle, but it's not a debacle. And I think our viewers and retail investors can take maybe some comfort or maybe some guidance in this is why we try not to make rash decisions.
Correct.
This is one, the jobs number is an estimate. It's based on data, that old garbage in, garbage out. We shouldn't make meaningful economic decisions based on one number that will likely get revised a month from now. So it's kind of like slow down, take a breath, look at the entire picture before making a decision.
Right. And also we're not hinging our investments based on the macroeconomic data.
Yeah.
The landscape we're in is important, but once again, we're always looking bottoms up.
Yep.
Company first. What are the underlying fundamentals? Because a fundamentally strong company, no matter what's going on in the environment, will be able to get through it.
And I meant that point more being to traditional retail investors not overreacting to one piece of headline news.
Oh, absolutely.
When you're looking at your portfolio, you're looking at your outlook, your long term, it's always nice to take a step back, take a breath, and really digest all of the numbers.
And in this, the way the market structure is now with the amount of quick information, that's why we're seeing the heightened volatility.
Yeah, absolutely.
We saw it last week on the announcement. Yeah, we had a big down day on Friday. Get through the weekend. Okay,
Everyone relaxes. Monday,
everything gets
boom, we're up.
recovered on Monday. Today, we're a little bit down. But then again, the market has been on a bit of a tear in the last couple months. So, August, September historically tend to be the weakest months of the year. Hey, we're rolling right into August after a strong July. yeah, we're going to have some chop here is the expectation.
And you did, I'll do it really quick. You
Yeah.
did mention interest rates and what's going on with inflation. So we'll talk about 3 major drivers of inflation. We'll do it quickly. Personal Consumption Expenditure Index. On July 31st, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.3% in the month of June. For the 12 months, the index is up 2.6%. The Producer Price Index. On July 16th, the Bureau of Labor Statistics reported that the Producer Price Index was unchanged in June. And on a year-over-year basis, the index is up 2.3%. The Consumer Price Index on July 15th, the Bureau of Labor Statistics also reported the Consumer Price Index increased 0.3% in June, and on a year-over-year basis, it's up 2.7%. So 2.3% to 2.7%. Again, not exactly where we want to be. The Fed would like to be closer to 2%, but it's not runaway inflation.
Well, year
like
over
we have
year,
seen.
we're not seeing any 3 handles anymore.
We're not seeing any 3 handles, and the trend is, I
Yeah,
I
that's
could go
good.
through it, but the trend is now it's ticking
correct.
down.
Yep, it's just kind of slowed down, but pretty stable, which is, stability is good.
It's good.
Let's talk about the portfolios. And what we'll see is it's kind of a mixed month in that you're seeing some divergence. I think we're seeing a little bit of speculation, exuberance coming back into the
feeling a
market.
little frothy,
a lot
Kelly.
of stuff, a lot of fraud starting to happen right now. Where that takes us, we'll see. We'll talk about that in a few minutes. But growth of income, good month in July. Oh, I'm sorry. Market-wise, I'm sorry. For the month, S&P 500 up 2.17%. The Dow Jones only up 0.8%, and the NASDAQ 3.7%. Obviously the big driver there was technology, AI companies, kind of the more super growthy type companies. The Russell 2000 up 1.68%. Internationally, we did see a pullback there. The EAFE down 1.45% for the month. Emerging markets, they caught a bit, up 1.67% for the month. Bonds, the aggregate bond index down 0.26. So we did see a little bit of bump in rates to the upside, which brought down the bond index. Year to date, that takes the S&P 500 to 7.78. Dow Jones only at 3.73%. The NASDAQ now up 9.38%. Russell 2000, which is small caps, even though they had a big month, was down 0.83% for the month. Internationally, the EAFE still leading the pack, up 15.67. Emerging markets, good year for them, up 15.6%. And overall, the U.S. aggregate bond index up 3.75, which for bonds, halfway through the year, 3.75, it's going to be a decent year for fixed income. Even though we're staying short, we're capturing most of it because the short-term rates are, at a pretty high level. Our portfolios, growth with income portfolio, good month, up 1%. Year to date, we're up 9%, so a good start to the year. Some of that was driven by NVIDIA, 13% for the month. Nucor up 10.5% for the month. Raytheon up 8% for the month. J&J up 8% for the month. So it wasn't just tech that worked in there. Laggards, Honeywell down 4.5%. Disney down 4%. Our international portfolio down 2.4%. Obviously, international stocks were down. Year-to-date, big gainers in the portfolio. Raytheon up 36%. NVIDIA, even after its fall, still up 32%. Gold up 25%. Microchip Technologies up 18%. Year-to-date laggards, Apple down 17%. So Apple's still struggling a little bit. Lennar down 14% for the year, and PepsiCo down 9% for the year. Dividend yield portfolio, this is really, always been our defensive portfolio. Pays a good dividend, high-paying dividend stocks, but also more defensive stocks.
Quality balance sheets.
Quality balance sheets.
Everything
We
you're
have
looking for
a
stability.
decent amount of energy exposure in there. And the reality, you also have a decent amount of multinational exposure in there. So for the month, up not 1%, which was good, but still, we're still lagging in here. We're still down 1.5%. So, struggling there. And once again, that's kind of shows that dichotomy where, your speculative growth way up and then your conservative stocks getting no love at all. July gainers, American Electric Power up 9%, J&J up 8%, Genuine Parts up 6%. Chevron up 6%. Avalon Bay for the month on the laggard side down 8.5%. Public Storage down 7%. Darden Restaurants down 7.5%. Year to date, our big gainers: American Electric Power up 23%. Cisco Systems up 15%. Amgen up 13%. Laggard wise, year to date, Packaging Corp down 14%. Public Storage down 9%. Price potential portfolio, ripped in July up 5%. Year to date, we're up 17%. Last year, price struggled a lot. Didn't make a whole lot of money. This year, we're killing it. Big gainers in July: Celestica up 28%. Advanced Micro Devices up 24%. Nucor up 10%. Google up 9%. Laggards: Option Healthcare down 10%. Harmonic down about 10%. Mercado Libre down 9%. They took it on the chin today, so not good for that. Year-to-date gainers: Meta up 32%, Microsoft up 26%, Amazon up 7%, and really year-to-date laggers, there's not much in there that we've held through the year that's down, so we really don't have anything listed there. Another year-to-date gainer, I mentioned it for the month, Celestica up 28% for the month. We've only held that since April. We're actually up close to 190% in there, so that's definitely been a big pull for the portfolio. Appreciation with the income portfolio. In July, we were down 1%. Year-to-date, though, we're still up 10%. Once again, we have more financial exposure in here. Not a lot of tech. Big gainers: Amphenol was up 8% in July. Microsoft, we do hold that up 7% in there. Broadcom up 6.5%. Our laggards, here we see the financials: Equitable down 8.5%. Synovus down 9%. CVS down 10%. Big gainers year to date: Meta's driven the portfolio up 32%. Lam Research up 31%. JP Morgan up 24%. Broadcom up 27%. Year to date, big laggards: Energy Transfer Partners down 8%. EOG down 4%. Our long-term price growth up 1.5% for the month, up 10% for the year. Once again, led by tech. Nvidia in July up 13%, Google up 8%, Amazon up 7%. Newmont Mining, a gold company, up 7% for the month. Laggards in July: Netflix took it on the chin, down 13%. Enovis down 14%. Royal Gold down 15%. So we kind of flopped out of Royal Gold into Newmont. Year-to-date gainers: Newmont up 67%, Netflix up 30%, Meta up 32%, Nvidia up 32%. Year-to-date laggards: Enovis down 38%, Merck down 21%, Apple down 17%. Small caps, once again, still struggling in the small cap arena, down 0.8%. Year-to-date, we're down 12%. And this really tells the story. When we look at the index, the small cap index for the month was up 1.68. Year to date, it's still negative 0.83. But the small cap index, really, there's out of the 2,000 stocks in there, actually, the biggest performers in the Russell 2000, the 14 largest performers, 10 of them have no earnings, actually. So
we're not going to own a company that has no earnings.
So there's a lot of speculation going on in small caps, and a lot of what's working are what we would consider less than ideal quality stocks. A lot of it's very speculative. Of our 40 stocks, only 3 are showing negative earnings at this point. So obviously we have a little different focus in our portfolio, and that's definitely causing the lag. July gainers: Liggard Pharmaceuticals for the month was up 18%. TAT Technologies up 16%. Northeast Bank up 11.5%. WNS Holdings up 18%. So we're finding some winners. But on the downside, Rupa Systrac down 16%. Paymeditis Holdings down 15%. Skyward Specialty down 12.5%. Year to date, our big gainers are Commvault up 26%. Northeast Bank up 8%. And Rupa Systrac down 25% year to date. So we've had a lot of turnover, trying to get some traction in there. we're sticking with the quality. We're not going to chase spec. We're not going to chase kind of the hot stocks.
Well, and this is really no different than what we've seen with the Nasdaq and the S&P, where a few stocks that are getting all the love, that are getting all the headlines, the ones you hear about every day, are really pulling the entire index.
Yep.
You eliminate those stocks from the Russell 2000, and as you said, it's not performing. So we're going to stick to quality. We're never going to chase a bid. We're never going to try to find the hot stock, especially one that's unprofitable. When you do consistency, good companies, and you do it over the long term, it absolutely works and makes sense, and that's our bias.
And we've seen that we're at a point now, as Cameron mentioned, things are getting a little frothy. They're definitely getting frothy. You got a speculative bid out there, a little bit of a comeback in the meme stocks. Some stocks are going way up that should not be going way up.
And people throwing money at cryptocurrency now.
Crypto has been on a little bit of a tear. We're starting to see SPACs come back, especially crypto SPACs. So some of the stuff that is a little questionable, we're starting to see it really
Am I getting a 1999 vibe?
I'm getting flashbacks to that. When you look at the bigger stocks, valuations are definitely stretched. And the thing is, we've seen this over the last several years, where we get to these points and we see a pullback, not a whole 2000, 2001 pullback, and then we kind of get right back into the rhythm again. But then again, as you mentioned, a lot of flashbacks to the late 90s, 99. It's definitely a different economy. We have a little different market structure. So, I'm always very attentive to kind of that worst case scenario. We need to keep our exposure there because the people that rely on some of these valuations have stepped out of the market several times and maybe not even gotten back into it over the last couple of years because valuations have been high. We're not really playing that game. We have some exposure to things that are working, but then again, we also have a good stable of more stable quality oriented stocks where that will definitely cushion our downside if we do see a major dislocation. And if it's a real major dislocation, because our exposure is minimal or is a reasonable amount, our recovery time should be a lot better, and we should be able to make money coming out of a longer term scenario if we were running into a real shift like we did see at the turn of the century. Don't know if it's going to happen. Who knows?
Sometimes being conservative, sometimes quality, sometimes focusing on fundamentals is not sexy.
Right.
But when it comes to chasing the bid and speculation, quality over the long run is going to pay off, and that's our bias.
And we saw it in 22. I mean, our downside was so much less than what the market's experienced, and you spread those returns out. We haven't given much up at all by being more conservative. So that's kind of where we're at. It's going to be an interesting August and September. Obviously, August has started off a little choppy. We got to keep the seatbelts on. We have decent cash, fixed income positions for dollars when they're needed. If you have big expenses coming up or you're going to need a chunk of dollars in the short term, please let us know. That's how we'll handle the short term chop. I think there's enough wind at our backs. Some good things that are going to be happening into the end of the year where. Yeah, I think we're going to have a good year this year.
And we could rally on some interest rate cuts
we
too.
could have that's exactly right. So you're going to have some good things that are going to happen, but just where we're at right now, expect some chop. By the end of the year, things should be pretty good, and we'll kind of see how we get through August. It's going to be a good month.
So thank you very much for the trust you place in us. As Kelly said, if you have any questions, if you want to talk about your account, please feel free to reach out to your advisor. We will talk to you again in a month, and have a great one.
Thank you.